Hey, good morning traders and investors, and welcome back to the Wednesday live stream show. I'm your host, Bennett Tyndall with TradingAnalysis.com. We appreciate you all taking time out of your Wednesday mornings. Good old May 11th. My goodness, this year is going by way too quickly. I know I say that all the time, but it certainly feels that way. So hey, we're back on our regular schedule this week. I had a procedure I had to take care of last week, so we decided to do the live stream last Tuesday. Kind of switched things up on you guys last minute, but we couldn't go 2 weeks without a show. Markets are, as you can see in the bottom left-hand corner of your screen, moving sharply lower following this morning's consumer price index report for the month of April. At the Fed meeting just recently, investors had been kind of considering the idea that Jerome Powell and the Fed may be more aggressive, and instead of a 50 basis point move, perhaps move forward with a 75 basis point move. Jerome Powell essentially dismissed that possibility, suggesting it's not on the table for the time being, although continuing to be data dependent. So that's obviously subject to the pace of inflation. And investors have been looking for signs of peak inflation to kind of support the idea that perhaps the Fed will be able to get away with and move forward with 50 basis point moves. We, of course, have the June meeting currently pricing at about an 85% chance of a 75 basis point, or excuse me, of a 50 basis point move. Only a 15% chance that they do move 75 basis points. I'll be curious to see how those probabilities shift following this morning's CPI data. Haven't had a chance to look over the report in detail. We've been getting ready for the live stream show. In fact, I was a couple of minutes late getting started chatting with you guys there in the chat. So hey, we've got a good show planned for you this morning. Before we get started and take a look at the charts, going through the indexes, let's bring in the trading analysis team. Good morning, Terry, and good morning, Alex. How are you guys today, gentlemen?
Just fine, Bennett, just fine. How are you guys doing?
Doing well. Recovering.
Alex, you get over your sickness?
Yeah, how you feeling, Alex?
Yeah, I'm fine. I mean, I didn't even have any major things, so just a sore throat, and that was it.
So pretty mild.
Just looking, looking this cryptos market in the last couple of days.
He says, "I don't care about COVID. I got volatility to handle." Yeah. I love it. Did you have COVID before, or was this your first time?
No, this was my first time.
First time. That's right. Yeah. Yeah. It's been a roller coaster. My goodness, you just look at your calendar and you think this has been going on for so long now that we'll see when and where it finally comes to an end. But yeah, definitely some volatile moves there in the crypto space, as well as the U.S. markets. The volatility here in 2022 continues. We've seen a lot of kind of back and forth. We're up against some good levels here to either confirm or dismiss a few outlooks. In terms of Bitcoin, of course, we have Crypto Lab tomorrow, 9 a.m. right here, 9 a.m. Eastern here on the Trading Analysis YouTube channel. We have Crypto Lab with Alex. He also covers the macro scene and macro environment, but he has an upcoming webinar this Saturday. If you're interested in taking advantage of that, tradinganalysis.com/crypto to get signed up. That will be this Saturday at 3 p.m. Eastern, noon Pacific. Perfect timing with the volatility on deck there.
Yeah, I mean, lots of interesting charts and lots of interesting opportunities ahead. We have been guiding our members for the last 2 years almost through this volatile back and forth, and most of them, and I will say most of us, are coming out of this undamaged and ready to buy whenever we see fit. So many people, of course, with the bearish sentiment are getting too bearish.
Yep.
So that is something that we're going to explain on Saturday, how this emotional sentiment is functioning, which is a rather interesting human feature.
Absolutely. Looking forward to that one. It's going to be a good event, as Alex mentioned. A lot of times when investors are kind of at their extremes is typically when we see opportunities present. So we'll go ahead and leave it at that. Yeah, Andy, sharp move lower there. You know, S&P futures we're trading 40.50, so we were trading north of the 4,000 handle, and we're trading a low now off of 39.47. Big sharp move lower there in the futures session. All right, Alex, Terry, I'm going to take them through the indexes. We'll be back on the other side. We've got a good show in store for you, some good content, and we'll go from there. Sounds good? Catch you guys in a couple minutes. All right, I'll be right back. All right, let's jump into it. Again, good morning. Thank you all for tuning in. We appreciate it. Let's hit it hard right edge of the Motive Wave platform. We're going to start it off first taking a look at the S&P 500. And before we begin and dive into any of the subdivisions, we just need to take a step back and remind ourselves of the progression that markets have been in and the overall corrective trend that markets have been in. And what we've been looking at in terms of the indexes is the idea that markets have confirmed, at the very least, a three-wave correction. And then as a worst-case alternate scenario, when we went into the month of April, we had essentially suggested April would either confirm the uptrend, suggesting that February 24th did mark the end of a wave 4 correction, or alternatively, if April proceeded to push south of major retracement support of this upside move, then that would be indicative of falling victim to the alternate, as we called it. So here we are looking at the S&P 500 and going back to the January 4th high. While it most certainly looks like we are falling victim to that alternate, pushing towards the 3,600 area target, we have to at least consider this possibility. And based on this morning's price action, it's becoming less likely. We'll see how this obviously carries over into the cash session. Future session not responding well to this morning's CPI data. But what we have in terms of structure, if we just break it down to the most basic of Elliott Wave counts, we have a 5-wave decline. And looking at this 5-wave decline, you may notice the overlap that we have here in wave 4. And as a result of that overlap, you may be inclined to suggest that as a leading diagonal. If it's a leading diagonal, clearly you can see this visually. Wave 3 is larger than 1. 4 is a larger percent retracement than 2. Wave 5 failed to exceed equality to wave 3, meaning wave 5 did not meet the requirements to suggest that as a leading diagonal. But for those new to Elliott, I want to remind you of the fact that if on a closing basis there is no overlap, it's entirely valid to be counted as a motive trend. So we're counting this as 5 waves down and 3 waves up into late March. From there, we have technically a 5-wave move that met support at a quality of C compared to A. Said otherwise, if you were to take a measurement, a Fibonacci measurement of this market decline, and project the magnitude of that descent from the wave B high, a quality would come in at 39.5982. If you were watching markets yesterday, markets met a low, and in fact, we'll do this really quick. See if I can switch this up. If you look at the bottom left-hand corner of your screen, here's the S&P cash session. Yesterday's low was 39.5817, and we proceeded to rally all the way back to 40, let's call it. So markets attempted to defend that equality measurement. In addition to that equality measurement, we also had our corrective trend channel. This corrective trend channel simply takes the high from January 4th. You draw your trend line through the high from March, project your parallel trend line over the low of wave A, and we have this intersecting zone of support, technical support offered in the S&P, which includes a 127% external retracement of the B wave rally, and of course that magic equality of wave C and A. This is also about a 50% retracement of the rally that started in October, late October of 2020. In addition, one of the other characteristics that we look for in a corrective trend is the guideline that suggests your C wave unfolds at a less significant angle of ascent or descent, or your C wave is more or less equal in time to the time elapsed in your A wave. Generally speaking, in a corrective trend, you're going to see momentum divergence into the C wave low, and you're going to see a less significant slope. And in fact, here in Motive Wave, we can actually draw a trend line here, and ask it to show the actual angle, which is 45 degrees here. We can go ahead and copy that, paste it, bring it over here. This was about 50 degrees. So it was a bit more aggressive. But notice when I measure time elapsed in C compared to A, we were close. We weren't spot on at equality, but we were close. Time equality would have come in May 23rd, more or less. In fact, actually, we need to go to the daily here. Yeah, May 19th, May 18th, May 19th, time equality would have come into the picture. So what does this tell us? What does this tell us? Well, if markets can defend that equality support level, based on all of the uncertainties and all of the variables that we've had to consider this year, technically speaking, it's possible that that marked the end of the correction. Now, there are certainly some issues with this view, mainly the consumer discretionary wave count and some of the other key tech components. So where does that leave us next? What happens if we break this corrective trend channel support and we do start to push south of C versus A equality? In that instance, we're right back over here into what was the alternate game plan going into the month of April. And the alternate game plan going into the month of April suggested that, in fact, we had a wave 1 completion of a higher degree wave 5 ending diagonal. If that's the case, it allows the two actionary waves that I continue to view as the only two actionary waves from the COVID low, to make a higher degree wave 1, because 3 waves, as you know, can't make a motive impulsive structure, but 3 waves can make a motive, wave 1, 3, or 5 of a motive diagonal. So this means we completed wave 1, and a break under equality has us targeting further, more significant fib projections, which include 35.91. So the way I'm looking to consider this is if we break that support zone, the confluence of fib support and trendline support, we're on our way back to 35.91, most likely in the S&P 500. But I'm not going to go as far as to say that our cycle degree uptrend has complete. I do not believe that we have the evidence to substantiate a cycle degree wave 5 completion. Therefore, said otherwise, we would expect this wave 2 correction to maintain positive support north of the March 2022 COVID low. There's been a lot of talk and uncertainty regarding the pace of inflation, the Fed, how the Fed's going to handle this, balance sheet runoff, etc. And a lot of traders, investors have considered the idea that a 40-plus year uptrend in the bond market has been derailed. And what's interesting about that possibility is, let's say, and I'm going to take you over here to 10-year yields really quick. I know Alex is going to cover this, but let's say that's true. Let's say this is true, and from the COVID low, we have a new at least 3-wave corrective trend, meaning this entire 5-wave move is just wave A of that 3-wave move. If this is the case, number one, we're above some key technical resistance. We have a 40-year downtrend line sourced from the 80s. We also have some fib projections. This view would suggest to me as an Elliottian, not considering the fundamentals of it all, and we've seen these hard right edge analysis views come to fruition and be of use. This would suggest to me that we've got a counter trend pullback in 4 and then a move up in wave 5 to satisfy a 5-wave trend from the March 2020 low. And while we're seeing the B wave correction, however it unfolds, triangle, zigzag, complex, while that B wave is unfolding, that's where I propose markets could see the completion of waves 3, 4, and 5 of the higher degree cycle trend. And then we're up against that more significant market correction. So that's the S&P 500. Over to the Nasdaq 100. If you've been following our work for any length of time, you'll know that we had a zone essentially at 15.3 to 16,000. That's the zone that we said last year could shut down price action in the Nasdaq. And while this could be the worst case scenario right now, I think it's more likely that this is also trading in a diagonal. We get wave 1, we get the wave 2 pullback that we're in, we get 3, 4, and 5, and then we get finally a 4th wave move to pair up to this 3-wave pullback from 2007 through 2008. And then once that move is over, the Nasdaq should be on its way in super cycle wave 5 of higher orange 3. Getting off of the longer term time frames, let me not scare you with the big bear count, and let's just break it down here. Now, looking at the Nasdaq, I know we talked just for a minute there about the S&P 500 exhibiting characteristics that were indicative of a corrective trend. Here in the Nasdaq, we're seeing characteristics that are indicative of a more impulsive trend. And looking at this move, this would suggest that the initial 5-wave move to the downside in the Nasdaq finished on the 24th of February. We have 3 waves back. The 3-wave correction took us into late March. And now, just like the S&P, we technically can count 5 waves, and we're rapidly approaching price equality. But notice how we approached price equality. We met price equality, or just shy of, okay, we're not quite there. 11,896 is price equality, but we did so in less than half of time elapsed in wave A. Typically speaking, not characteristic of a correction. Doesn't mean it's not, but this would tend to favor the more significant bearish view that would suggest we're going to see the more substantial 1618 downside projection. The 1618 downside projection here in the Nasdaq 100 takes you down to 10,330 spot 49. That would be more or less a 50% retracement of the move up from the COVID low. So that's the Nasdaq and the S&P. I'll take a look at the Russell 2000, and then we'll go ahead and get back over to the team and carry on into sector focus. Looking at the Russell 2000, while we have adopted our view here that suggests this is on its way to 1647, spot 59, quality of C compared to A, this could just be wave 1 and 2 of an ending diagonal. Maybe it's wave 1 and 2 of a motive wave, and we see small caps, attempt a reversal here at what would be this wave 1 swing point and the equality of C compared to A. Diving into this structure, we have 5 down of A, 3 back of B, 1, 2. It looks like smaller 1, 2. We're going to go a series of 3, 4, 3, 4 moves. We should ultimately see 1647.59. All right, very interesting market. Good morning, Todd. Good morning, Richard. Glad to have you guys on with us. Good morning, Tristan. Scary. Now we're here to trade the market. We're here to trade the swings, and of course take advantage of these for other purposes. So that's it for me this morning. We're going to go ahead and jump back over to the trading analysis team. What do you guys think? 3,600 in the S&P on the horizon?
Certainly possible. I mean, we're already back. This is we're trading right now at the year's low for both indexes, and actually you kind of have to go back about 14 months now. So basically, we've wiped out 14 months worth of if there were some gains in there. If you didn't sidestep the market. And so some of our traders have sidestepped the market. We haven't really taken on any dramatic bearish positions, I would say, but we are trading a few things with our clients to try to take advantage of the situation. Now, one thing we hadn't talked about yet is gold and gold futures, and I'll get into that in a moment. So I do want to hear what Alex has to say about that.
Absolutely. You want to go macro first, Terry, or do you want to do sector focus first?
That's fine with me. We can do the sector focus. I'm not going to change what I'm going to say, but just interested. The dollar index is really, I think, the key thing that's been holding the gold down. And so if we get a release in that, watch out. Gold and crude both could continue higher.
All right, sounds good. Let's jump into it. We're going to carry on into the Optima platform now, the second key tool here at Trading Analysis. Terry's going to take you through sector focus. We'll be back on the other side to take a look at macro with Alex. Take it away, Terry. We'll catch you in just a few minutes. Sound good?
All right.
All right, take it away.
Good morning, traders. I'm Terry Long at TradingAnalysis.com here with your weekly sector focus. Yes, Mother's Day is already come and gone. The year is moving by fast, as Bennett has said. Last week, markets anxiously awaited for Wednesday to hear Jay Powell announce another rate hike of 50 basis points. But when asked the question if the Fed would consider 75 basis point hikes, that was a direct question asked by a CNBC correspondent. Powell immediately replied that the Fed was not even considering 75 basis points as an option. Markets immediately prompted a move sharply higher, as if on cue. That was very interesting. That was Wednesday here. The subsequent daily close for Wednesday saw the S&P shoot up 3.16% from Tuesday's close. The NDX similarly advanced 3.56% on Wednesday. Now, no more Fed speak happened. Traders just went to sleep. They woke up the next morning, and after thinking about it, it seems like they decided to reconsider the proposition of a somewhat less hawkish Fed. Thus, Thursday, the markets reversed sharply here to the downside, wiping out the entire weekly gains in just a single day. The S&P closed down 3.73%, closed below Wednesday's open. The NDX reversed all of its gains that it had made on Wednesday to close down just over 5%. Tough day. Now, for the week overall, the S&P only ended up with a 0.21% decline. So very wild and choppy, but as far as the delta from one week to the next, very small. Now, admittedly, the NDX did close 1.25% lower, so a little stronger to the downside, netting a fifth week decline for both indexes, fifth week in a row. So the question will be whether we're going to continue that or we're going to get a sharp bounce through the rest of this week and get ourselves back up in positive territory. Bennett's giving you the analysis for that. Now, in terms of individual sector performance last week, the elephant in the room was certainly here, the energy sector, rising 10.34% for the week. Far outshadowed the moves of any other sector. Last week to the downside, though, real estate sector did decline 3.8%. That was the second large week in a row of real estate declines. And consumer discretionary down 2.9%. But relatively speaking, all the other sectors saw kind of nominal performance. Well, let's fast forward here, or sorry, let's go ahead and move this over here. Let's talk about Monday and Tuesday's price performance. Now, crude oil took a major turn lower after the weekend on Monday, resulting in over an 80% loss in a single day of the entire week's worth of gains made by the XLE. Let's take a look here and pull this over here. So right now I'm looking at the XLE down 6.11%. Last night when I wrote my notes, it was down 7.56%. So there's been some overnight movement. Overnight crude rose back up from the sub 100 mark, trading now, I believe, at about 102.3. Now, all 11 sectors this week, this is Monday and Tuesday's data here, are currently in the red. And like I said, are we going to see a sixth consecutive down week? The S&P is already off last week's close by another almost 3%. And futures are sliding this morning after the CPI announcement. Futures actually had been trading up. I did tell the crew this morning, I saw Asian markets close higher. European markets were trading higher. So there might be an expectation U.S. markets could follow that. But yeah, everything on the board is red. Let's move over to the relative strength sector leader scoreboard here. And after seeing 8 weeks of momentum decline at mostly constant relative strength decline, look here, you can see how far back that goes. That's just almost a constant relative strength loss. That big 10% shift in energy last week to the upside caused a rapid increase here of relative strength, and then the snap back this week. This last Vectors week is only 2 days old, so give it some more time. But man, that's a sharp whiplash, you know, getting there, and that could set the stage, if this continues, then for a sharper decline here in energy to come. Now, the utility, staples, healthcare, materials, real estate, and industrial sectors still remain here in the leading quadrant. They do continue to outperform the benchmark S&P to various degrees. Now, remember, S&P is going down. All of these sectors could be going down too, but the fact that you're seeing northeasterly heading here, like in staples and also here in materials sector, means that these sectors are holding on to their gains better than the overall broader market. Now, like I said, real estate had made about 2 weeks in a row of some pretty sharp negative declines. That's caused a rapid hook reversal here, kind of unexpected, but with rising mortgage rates, who knows? Maybe that's going to put some serious pressure in the real estate market, and we could be seeing a big turnaround there. Industrials is kind of the weakest of all of our leaders, but it is in the leading quadrant and is kind of meandering here. The serious decline that we had in the financial sector over the last several weeks has pushed it down into the lagging quadrant. We are getting a bit of a northerly hook starting to form, but it's very early here. I think some of these financials are getting beaten down. They might be poised for a bit of a turnaround. But financials has joined technology and discretionary down here in this lagging quadrant. We have seen a slight bit of northerly movement back up here in technology. Discretionary continues to struggle. And the communication sector actually gave us a slight hint of rising momentum, but it has yet to really begin any sort of breakout and move. So I did mention something about gold. Let's go jump over here. I'm going to jump ahead of Alex on this, and we'll hear what he has to say. Because we did attempt to put on a position thinking we might have an early swing coming out right here off of the May 3rd bounce, possibly turning around. We took a small speculative play with the clients. We did get stopped out on that. And we close that position, and we'll wait until we get a little bit better confirmation that we've got a closure. If indeed this is the pattern and we don't see gold sink further, we are still looking at this as a bottom rounding area here. Last week and this week, Monday and Tuesday, and whatever is going on, markets aren't open yet this morning. Most of the gold miners are still in negative territory. Okay, so most of these are still declining, but we are watching tentatively this area right here to see if we get gold to break out of this. And I think that's really going to be dependent upon what Alex tells me where this is going to happen if we look at the dollar index. Okay, that's all I've got for now, viewers. I'm sending it back to you, Bennett.
Very good. Much appreciated, Terry. Yeah, don't forget to mention the B-Wave short. We shorted the B-Wave first, took advantage of the downside move, rolled some of that into a speculative, and we'll continue to keep our eyes on that.
We made a nice short trade back up here for sure. Yeah.
All right, Alex, I'm going to pass presenter mode your direction. Let's see here. You got the screen coming your way, sir?
Yeah, he's got it.
All right, excellent work as always, Terry. Alex, sir, let me know when you are ready to go. We'll get rocking again. Webinar this Saturday. This will be 12 p.m. Pacific, 3 p.m. Eastern, talking all things crypto, specifically looking at the opportunity that Alex sees on the horizon in Bitcoin. Check that out, tradinganalysis.com/crypto. He will, of course, be chatting more about this tomorrow morning, 9 a.m. for Crypto Lab. Alex, you ready to rock, boss?
Yeah, let's go.
All right, let's hit it. We'll be back on the other side to wrap up. Markets open in 7 minutes.
Hey guys, let's look a little bit over a macro scene as we are doing every Wednesday. So we are using this CME Fed tool just to see what markets is kind of looking for the next rate hikes. As you can see, the next meeting, 15th of June, market is starting to pricing in another 50 basis points move on the upside. And even 75 basis points, as you can see, starts to climbing from yesterday. I looked this chart yesterday. CPI came a little bit lower, so I don't know if they're going to do 75, although Jerome Powell was saying that he will stick with 25 basis points. So let's see what is going to happen. That's not far, like in 20 days. So looking at the chart of the 10-year yields, in all of this, we are reaching the resistance levels that I talked about. So this is the 40-year chart of the US 10-year yields, and of course, deflationary movement to the downside. Every of these highs on the RSI on this weekly chart was followed by the sharp decline, as you can see. So we are touching this line a second time. I do think we're going to have a rather a pullback very soon. You have seen the wave count from Bennett, and I completely agree with it. I think we are going to see the 5-wave completion soon, and we're going to see a pullback, and then we will go from there to see, are we going to produce another C wave on the upside, which is very possible. Looking the energy prices, which I will show you just in a second. But we do see a potential correction. We will see how much this correction will actually go to the downside. But definitely, I think, and I agree, as I said, with the Bennett wave count, 1, 2, up in 3, triangle 4, and we are tracing out the last subdivision in this wave 5. So we can expect a move lower soon. And I also mentioned last time, I do see that also in a couple of commodities. So let me just briefly mention the European situation. ECB started to be vocal of starting to moving rates on the upside. They're still doing the QE. As you know, due to a current war between Russia and Ukraine, European Union is not in such a good place currently. We still don't see a 5 waves up here on the German government bonds 10-year as well. And ECB was announcing a potential change in the monetary narrative with the possible hikes. I don't know, to tell you honestly, that they can do the same inflation catch up as the US, because from many perspectives, European Union is on the much worse place for that type of move than the US. I've shown you a couple of times this forward 3 months Euribor curve. They are pricing in up to 1.35, 150 until the end of December 2023, where projected Fed funds can be around 2.5 to 75% if we go on the same pace. So dollar index is moving higher. We talked about that last week, where we were trading around 101. We are trading around 103, and we do see this as a third wave expansion on the upside. So even here, I do see with these rates move lower, a small pullback in the fourth wave, and then a continuation. Worst case scenario, we can go up to 108, 110. Best case, this wave 5 will be a little bit smaller because of some fib ratios, but I do expect a small correction or a consolidation relatively soon in dollar index. That will depict a 5-wave sequence completed, and we can look for some type of a pullback on dollar. As the oil is concerned, we are still trading sideways. I have mentioned this chart a couple of times. As long as we stay between this range, which depicts a previous correction, which now acts as a kind of consolidation and support, we need to break down 95, 96 levels to look oil a little bit lower. Until then, we are still trading in a range. And the more we stay in this range, this will look more and more like a triangle, which will actually imply that we might break out on the upside forming some type of the orange wave 3. European Union is going back and forth between the countries to put an oil embargo in a couple of months. We will see how that will go. But if we look technically the price section, we are staying and consolidating sideways, which is not a good sign. And more we consolidate, as I said, the probability will grow. We're going to break in the direction of a trend, which means on the upside. We mentioned the net gas last week around 7. We went around 8, almost 9. Fib target is around 10. So we are still consolidating here. This can be some type of a 5-wave sequence. And I do see also in the net gas some type of a correction, which will ease off temporarily a little bit of inflationary pressures in the next couple of months. As you can see on the other charts, I have shown you this correction to come, actually potentially to come in a couple of weeks. And I think it is going to happen because the wave structure is relatively clear from this lows wave 1 and 2 up in 3, 4, and 5. So we are going to face a higher gas prices in the most likely whole of 2022 after this correction passes, even a spillover in 2023. If we look Thomson Reuters CRB index, which I have been regularly showing here last couple of weeks, we are seeing a small pullback, which means that if this develops in a 5-wave move, the first 5-wave sequence will be over. We are going to go in this B-wave correction, which also agrees with a little bit lower commodity prices, maybe a couple of weeks or even a few months ease off of inflationary pressures, and then we might continue further on the upside. I still need 5 waves down to confirm this, but I have one ratio which I've shown last time, usually with which we measure a potential expansion of the wave 5 or development of the wave 5. 0.38 fib ratio is right there, so we are starting to backing off, and any 5-wave move down back in 267 levels will mean actually that the A wave of the ABC corrective move has started. So I have also shown you a couple of times the gold silver index, and I have been very specific of potential gold having an edge while this correction plays out over silver, which is actually happening because we are seeing gold trading lower, but not much lower than the silver actually is doing. That also might change if we break some levels, which I will show you now. So I've been relatively vocal on my suspicion in regards of the movement up in the gold and silver, because in the situation when the war started, gold was able to do only $200 on the upside, and we are moving lower. So current situation, we need actually to hold this level 786, equality of A up in B down in C. We have talked about this a couple of weeks back that we expect at least a 3-way pullback down to this zone, and actually we reached our target. So if we want to be a gold bullish, we want to see a clear 5 waves up trading very close to the previous swing high, which means that was a B wave. So I want to see gold going in a 5 waves up back to 2000 level, small pullback, and the probability actually then will increase that this was the final low and the gold will continue moving higher towards 2300, 2500 target. Okay, so if we start pushing lower and actually challenge these previous lows, I think gold will be in the relatively messy situation, moving further lower in some type of A up in B down in C. So this will be some type of regular flat, challenging this 38% 4 versus 3. So it means it's a 4th wave ratio down to 1672. So a big decision time here for gold. If we see a break of this level on the downside, I think the next target will be around 1,750 and below. If we somehow stage a 5-way move on the upside, I will become bullish on gold, because the probability of these lows to be confirmed and actually post a reversal signature will be much higher than in the other case. If we look also silver, I think you have tracked our streams for a long time now, and Wave X actually was just a 3-way move. We didn't see a 5-way move on the upside, although market was pretty bullish and excited to see this. That's why I always talk with my members. In a crypto space, we always need to see a 5-way move on the upside, because the probability will be higher that reversal might be at hand. This is a 400 days of a support here, even more now. So I don't think this will break so easily. We might see back and forth, a small breakdown to 18, 19. So I think then we need to see also 5 waves up trading around 25 to 24 with a previous swing high there, and then a pullback will offer a low risk trade actually for potential longs in silver. At least that's how I will construct something on silver looking this chart. So silver moving down more than gold and challenging this level, possible small consolidation or move on the upside, and then I think we're going to break these levels, take some stops, and then actually 200 moving average comes around, I think, 1950. So my zone is from 1920 to 1950 for a possible lows on silver. In cryptos are pretty much a big bloodbath this last couple of days. I will just show you this chart. I didn't show this to Terry and Bennett. This was a chart of Luna, one of the projects in the last couple of days. I'm not going to go into it, what happened there. I'm going to explain that on the Crypto Lab tomorrow, but almost, I don't know, from 75 couple of weeks, so we are trading around 1 currently. So a pretty dramatic fall from a 5-way move on the upside. So definitely cryptos will become very interesting, I think, in the next couple of weeks, because I think many of these altcoins will offer, especially viable and good projects, a pretty cheap opportunity in the crypto space. So back to you, Bennett.
Much appreciated. Thank you so much, as always, Alex. Yeah, my goodness, what a move down in that particular coin there. Sorry, I was just responding to a few things in chat here. Got a bit distracted. Markets are open. S&P 3974 currently. Haven't seen a sizable move just yet. Team, excellent work as always. Traders, investors, appreciate you all tuning in with us today. Again, tomorrow morning, 9 a.m. right here on the Trading Analysis YouTube channel. We do have Crypto Lab with Alex. He'll be talking about the volatility in the crypto space. Richard, yeah, regarding your gold suggestion, that is absolutely something we've been tracking with clients in terms of viewing that 2078 high that we had recently as a corrective move. Alex has it as a complex. We're also tracking it as a flat, where that 2078 move was a B wave. The difference is obviously, as you know, would be either 5 down of C or 3 down to complete the complex correction. So we'll continue to keep our eyes on that. If you guys did enjoy the content, yeah, go ahead.
On that front, I always, I mean, when you're dealing with Elliott waves, when these corrections have multiple possibilities, I always suggest to look the overall context, then particular wave count, because you have a clear levels when the probability increases that you are in one or the other form. So I always do point out with people trying to get correct in the wave count, you should keep all possibilities open and just look for these small details which will actually tell you the probability increase in your wave count. So better focus on a context, what might happen, and the major support levels. The wave count will show itself on the end. So just a small advice.
Yeah, very good, very good. Yeah, it's definitely worth, so many people when they have the interest or the idea that they're going to learn Elliott Wave, they'll approach a market and they'll say, this is absolutely positively the only possible account. And then when it doesn't go their way, they're left scrambling for context. So
I was the same. Yeah, I was the same. But,
yeah, I think we all fell victim to that, initially on in learning Elliott. It's definitely.
So one interesting thing in one moment, Todd asked me, because we go way back, tell me your thought process, and I didn't have much to say on that because my thought process was the only possible wave count.
This is the count. I love it. I love it. We've seen that historically typically get people in trouble. So we.
I learned the hard way.
That's right. All right. Hey,
all right, guys.
Viewers, appreciate it. Members, we'll see you in about 20 minutes for our weekly member webinar. Viewers, we'll see you next week. Give it a thumbs up. Subscribe with notifications if you did enjoy the content. Let's the good old YouTube algorithm know to distribute it accordingly. All right. Alex, Terry, solid work. We'll see you guys in the member webinar. Have a good one.
See you later.
See you next week.